This is India's #1 news network, and you're watching News 9. English news as it should be.
Very good morning. You're watching News 9. I'm Karthik Malhotra. Well, Delhi has woken up to a thick blanket of fog, putting travel schedules on both flights and trains to a toss. That's the big story we're bringing for you this morning. Also on the show, we'll tell you all about the much-awaited US President Donald Trump's meeting with Ukrainian President Volodymyr Zelenskyy. What is the outcome of that meeting? We'll tell you all about that on the show today. Also, silver prices have seen a rally like never before, and don't go anywhere, because in the second half of the show, we'll bring you two fabulous market experts to tell you how you should plan your 2026 investments. All this and more on this edition of Morning Brief at 9. This is Morning Brief at 9. First up, let's bring you all the headlines we're tracking for you this Monday morning. Heavy fog and toxic smog blanket Delhi NCR and large parts of North India, disrupting flights and train services as visibility drops to near zero in the NCR region and air quality plunges back into the very poor and severe categories. US President Donald Trump meets Ukrainian President Volodymyr Zelenskyy in Florida, acknowledges that Kyiv and Moscow remain deeply divided over territorial control despite ongoing efforts to push peace talks forward. US President Donald Trump claims Russian leader Vladimir Putin wants to see Ukraine succeed, though access to low-cost energy and other resources. Comments likely to raise eyebrows amid the ongoing war. Canadian Prime Minister Mark Carney announces a $2.5 billion aid package assistance for Ukraine, reinforcing Ottawa's long-term support for Kyiv as the war with Russia drags on. Silver prices retreat sharply after surging past the $80 an ounce mark for the very first time as traders lock in profits following a record rally fueled by tight global supply. India's forex reserves crosses the $693 billion mark as per RBI data, mainly on account of gold holdings and the price surge of the yellow metal this year. RBI says reserves sufficient to cover for 11 months of imports. Foreign institutional investors pull out 1.6 lakh crore rupees from Indian equity markets in 2025, marking the worst year on record for foreign fund outflows amid global volatility and valuation concerns. Chinese automaker BYD is all set to surpass Tesla as the world's largest electric vehicle seller, with 2025 sales data indicating Elon Musk's company unlikely to retain its global lead. And China announces large-scale military exercises near Taiwan, including live fire drills across multiple zones, sharply escalating tensions in the Taiwan Strait. And the big story coming in this morning: from the dense fog and smog visible across parts of North India, especially Delhi NCR, putting flight and train schedules in a bit of a chaotic situation for travelers. Well, heavy fog has engulfed Delhi and parts of NCR, bringing visibility down to dangerously low levels. And at the same time, air quality across the region has worsened significantly, with several areas recording severe AQI levels. Now, overall, AQI of Delhi as of 6 a.m. this morning stands at 405. Now, in Anand Vihar, the air quality index has surged to 462, categorized as severe. Neighbouring Noida, Sector 125 has also recorded an alarming AQI of 414, remaining in the severe category. Now, in Delhi's border areas, Wazirpur has reported an AQI of 444, while Chandni Chowk stands at 426, both under severe pollution levels. Now, Patparganj has touched 434, adding to the growing concern around air quality. In South Delhi, JLN Stadium has recorded an AQI of 414 this morning, and City Fort is close behind at 428, both again in the severe region. Meanwhile, ITO has reported an AQI of 405, continuing the severe pollution trend seen across the national capital. In view of dense fog and severe cold, a major decision has been taken regarding schools in Gautam Budh Nagar, that's Noida. On the directions of the district administration, the district basic education officer of Gautam Budh Nagar has issued an order declaring holidays in all board-recognized schools across the Noida district. According to the order, all CBSE, ICSE, UP board and other recognized schools in the district will remain closed from today, that's 29th of December, till the 1st of Jan 2026 for classes from nursery to class 12. Now, this decision has been taken to ensure the safety of students amid dense fog and extreme cold conditions. However, the order also clearly states that teachers and staff of council-run, aided and government schools will be required to report to schools at the scheduled time, and administrative work will continue as usual. The district administration has directed all schools to strictly comply with the order. And due to the cold wave and the heavy fog in northern India, dense fog has significantly reduced visibility, causing delays in flight and train operations. Now, visuals from Ahmedabad airport show passengers affected amid flight disruptions caused by persistent dense fog. As cold waves grip the national capital, a few flights at IGI airport have also been delayed. An Air India Express flight en route to Delhi from Goa's Mopa airport was diverted to Ahmedabad due to heavy fog. The Delhi airport has issued an advisory urging passengers to keep checking real-time updates. In Jammu too, dense fog continues to affect visibility, impacting flight operations to and from the Jammu airport. As conditions evolve, some services may experience delays and a few may need to be cancelled depending on clearance and operational feasibility. Passengers have been advised to check the latest flight status on airline websites or apps before heading to the airport. And moving on now to global stories. In a pre-New Year diplomatic peace push, US President Donald Trump met Ukrainian President Volodymyr Zelenskyy in Florida on Sunday. Now, this meeting came just a day after Russia launched fresh attacks on residential areas of Ukraine's capital, Kyiv. Now, Trump, who had promised a peace deal on day one of his nearly year-old presidency, said it would become clear within weeks whether it was possible to end the war that has killed tens of thousands of people since February of 2022. Now, despite projecting optimism, Trump offered few details on real progress, instead criticizing former US President Joe Biden's multi-billion-dollar military support to Ukraine and highlighting his own personal rapport with Russian President Vladimir Putin.
We had a terrific meeting. We discussed a lot of things. As you know, I had an excellent phone call with President Putin that lasted for over 2 hours. We discussed a lot of points, and I do think we're getting a lot closer, maybe very close. Russia wants to see Ukraine succeed. Once, it sounds a little strange, but I was explaining to the president, President Putin was very generous in his feeling toward Ukraine succeeding, including supplying energy, electricity, and other things at very low prices.
Trump admitted that Kyiv and Moscow remain divided, mainly on territorial control. The latest proposal, shaped after weeks of intense US-Ukraine talks, would freeze the war along current front lines in eastern Donbass with a demilitarized buffer zone. Russia, however, continues to demand territorial concessions.
Mr. President, have you agreed on the so-called free trade zone on Donbass? How to separate the sites? How to make the separation line? Who will be responsible?
The word agreed is too strong. I would say not agreed, but we're getting closer to an agreement on that, and that's a big issue. Certainly, that's one of the big issues, and I think we're closer than we were probably. It's unresolved, but it's getting a lot closer. That's a very tough issue, but one that I think will get resolved.
Meanwhile, Ukrainian President Volodymyr Zelenskyy, along with several European leaders, took to social media on Sunday to thank US President Donald Trump and welcome what they described as progress in peace talks aimed at ending Russia's war in Ukraine. According to reports, Russian President Vladimir Putin told Trump during a telephone call earlier in the day that a proposed 60-day ceasefire backed by the European Union and Ukraine would only prolong the conflict. Meanwhile, Zelenskyy maintained a noticeably cautious and courteous tone during his visit to Florida on Sunday. The Ukrainian leader appeared keen to avoid a repeat of his contentious White House meeting on February 28th, when Trump and Vice President J.D. Vance publicly criticized him for a lack of gratitude for U.S. support. Staying with this story, Canadian Prime Minister Mark Carney on Saturday announced an additional $2.5 billion in economic assistance for Ukraine. Prime Minister Mark Carney said the aid would help Ukraine unlock further financing from the International Monetary Fund. He was speaking alongside Ukrainian President Volodymyr Zelenskyy, who also briefly addressed reporters. Zelenskyy met Carney while en route to the United States for talks with President Donald Trump in Florida and expressed hope to find a compromise on a peace framework to end Russia's war. Listen in.
Under President Zelenskyy's leadership, we have the conditions, the possibility of a just and lasting peace. But that requires a willing Russia. And the barbarism that we saw overnight, the attack on Kyiv, shows just how important it is that we stand with Ukraine during this difficult time, and that we create the conditions for this just and lasting peace and a true reconstruction. We're announcing today further economic assistance for Ukraine, $2.5 billion worth of economic assistance that helps unlock financing from the IMF, from the World Bank, from the European Bank for Reconstruction and Development, to begin this process of rebuilding.
This attack is, again, Russia's answer on our peace efforts, and it's really shows that Putin doesn't want peace, and we want peace, and he's the man of war, but he's afraid to speak about publicly. But we see the steps, and what we need to stop this war in any way, and we need two things: pressure on Russia and sufficient strong support for Ukraine.
All right, and staying with other global stories, but moving away from Russia-Ukraine conflict, let's now look at China, where China's private rocket firm Landspace is driving a cultural shift in the country's space industry, long dominated by cautious state-owned giants, by openly embracing a startup mindset inspired by Elon Musk's SpaceX. For decades, China's state-led space program avoided public discussion on launch failures. This contrasts sharply with Western companies like SpaceX, which routinely broadcast test mishaps as part of rapid innovation. But this month, Chinese state media openly reported the country's first two failed attempts to recover reusable rockets. The second failure involved a state-owned firm coming just weeks after Landspace's maiden launch of its reusable rocket in early December this year. Now, founded in 2015, Landspace has consistently acknowledged SpaceX as its inspiration and was among the earliest startups to enter the sector after China opened parts of its space industry to private investment back in 2014. Beijing now sees reusable rockets as strategically critical. They have enabled SpaceX to deploy thousands of Starlink satellites into low Earth orbit, a scale China is expected to take decades to replicate. Landspace's focus on building a low-cost, reusable launch system is expected to play a key role in China's long-term plans to deploy satellite constellations numbering in tens of thousands. And moving to US now, Wall Street ended a thinly traded post-Christmas session almost flat on Friday as light volumes and a lack of major triggers kept investors on the sidelines. With no strong catalyst to drive markets decisively either higher or lower, benchmark indices finished little changed. Now, among individual stocks, Nvidia, the AI chip maker, gained after agreeing to license chip technology from startup Grok and announced plans to hire the company's chief executive. Take a look.
U.S. stocks ended nearly unchanged in light trading on Friday, with the Dow, S&P 500, and NASDAQ edging nominally lower to snap a 5-session rally. Still, all three indexes logged gains for the holiday-shortened week. Just 3 trading days remain in a turbulent year in which tariff jitters, simmering geopolitical tensions, and the rapid growth of AI-related momentum stocks took investors on a bumpy ride. But it was a year that put the 3 major indexes, led by the tech-heavy NASDAQ, on track to register double-digit percentage gains. Stocks on the move on Friday included Nvidia, which gained 1% after the AI chip maker agreed to license chip technology from startup Grok and hire its CEO. Shares of Target rose more than 3% after the Financial Times reported the retailer is facing activism from hedge fund Tom's Capital Investment Management, which has made a significant investment in the company. And U.S.-listed shares of precious metal miners such as First Majestic, Core Mining, and Endeavor Silver advanced as silver and gold prices touched fresh record highs.
And those fresh record highs, remember, after a blistering record run, silver has now hit reverse. The white metal pulled back sharply after surging past $80 an ounce for the very first time as traders booked profits following a record-breaking rally driven by a tight supply-demand imbalance. Silver fell as much as 5% on Monday after briefly hitting a fresh high of $84 an ounce, following 5 straight sessions of gains. Now, silver's sharp rise capped a years-long rally in precious metals fueled by heavy central bank buying, strong inflows into exchange-traded funds, and 3 consecutive interest rate cuts by the U.S. Federal Reserve. Lower interest rates tend to support commodities like gold and silver, which do not offer yields, with markets now betting on further rate cuts in 2026. Analysts say silver has outperformed gold partly because of its thinner market. Unlike gold, which is backed by deep liquidity in London's bullion market, silver has limited inventories, making prices more volatile. Technical indicators now suggest the rally may have gone too far too fast. Silver's 14-day relative strength index climbed close to 80, well above the 70 levels that signals an overbought market. And India's foreign exchange reserves rose sharply by $4.4 billion to as high as $693 billion in the week ended December 19th. This as per the latest data released by the Reserve Bank of India. The increase was largely driven by strong rise in gold reserves, which jumped $2.6 billion to $110.4 billion during the week. In the previous week, the overall forex kitty had grown by a more modest $1.7 billion to as much as $689 billion. Foreign currency assets, the biggest component of the reserves, increased by $1.6 billion to $559 billion, according to the RBI's weekly statistical supplement. Now, these assets reflect valuation changes due to movements in non-US currencies such as the euro, pound, as well as the Japanese yen. India's reserve position with the International Monetary Fund rose by as much as $95 million to now as high as $4.8 billion. Now, gold prices, remember, have remained on an upward trend in recent months amid highlighted and heightened global uncertainty and strong investment demand, boosting the value of India's gold reserves. After its latest monetary policy review, the RBI said India's forex reserves were sufficient to cover more than 11 months of merchandise imports, underscoring the resilience of the country's external sector. The central bank also noted that India remains well positioned to meet its external financing needs. Now, India added around $58 billion to its forex reserves in 2023 after a cumulative decline of $71 billion in 2022. Now, in 2024, reserves rose by just over $20 billion, while so far in this year, until December 19th of 2025, the Forex kitty has grown by an estimated $47 to $48 billion. Now remember, Forex exchange reserves are assets held by the country's central bank, in India's case, the Reserve Bank of India, mainly in reserve currencies such as the US dollar, along with holdings in the euro, Japanese yen, pound sterling, as well as gold. And Indian stock markets have witnessed the worst ever outflows from foreign portfolio investors as well as foreign institutional investors. Now, in 2025, this has been a trend as sentiment towards Asia's third largest economy, that's India, remained fragile, even though corporate earnings and domestic consumption showed signs of recovery, at least as far as India's fundamentals and macroeconomics go. As of December 27th, FPIs had sold as much as 22,130 crore rupees worth of Indian equities through exchanges, extending their selling streak to a sixth consecutive month. Now, this has taken cumulative secondary market outflows to almost 240,000 crore rupees. In contrast, FPIs remain net buyers in the primary market, pumping in as much as 73,583 crore rupees during the year. Now, including these inflows, total net outflows for the calendar year 2025 stands at 1,58,407 crore rupees. And remember, we still have another 2 or 3 trading days left. Now, this has made India and 2025 in India the worst annual outflow on record. Now, out of the last 12 months, FPIs were net buyers in only 4 months, that's March, April, May and June. Earlier in the year, India was among the first major markets to rebound after US President Donald Trump announced global tariffs on the 2nd of April, attracting investors who saw the country as a safe haven amid trade tensions. However, both countries did not finalize a trade deal despite multiple rounds of negotiations. Now, adding to the foreign investor woes, Indian rupee has lost over 5% of its value this year, making it the worst performer among its Asian peers. A weak rupee directly reduces the dollar value of FPI investments and raises perceived risks, prompting foreign investors to withdraw capital in search of safer and more stable returns. And those FPI and FII outflows are obviously still continuing to bother investors on the Lal Street. Markets, as expected, have opened flat this morning. Remember, no real triggers, no real cues either in the positive or the negative territory as far as trading this morning goes. The weekend was pretty much flat with nothing sizable really coming in for the Indian equity markets to react on. But things are not as bad as they were, at least, a couple of months ago. As things stand right now, Sensex and Nifty both checking those critical levels, with Nifty 50 above that 26,000 level, marginally just about 60 points above, but above 26,000, and the Sensex above the 85,000 levels, again just about 50 odd points. Meanwhile, the small cap and the mid cap are seeing a little bit of pressure, not much. Again, this is almost a flat trading session, at least as far as the first 5 minutes or so of trading go, where you're not really seeing too much volatility also in the markets. So look at the India VIX, that's the fear index of the Indian stock markets. It's well below 10. Remember, 11 to 12 was the range that we had seen during those extensive talks that surrounded the entire narrative around the Trump-imposed tariffs on India. But volatility in the Indian markets is also low. It's at just about 9.64 or so this morning. Let's pull up the Nifty 50 heat map and try and see which are the sectors which are reacting favorably or negatively this morning. And the Nifty 50 heat map on your screens now shows that Reliance Industries is down about 0.3% or so, almost 0.4% or so in trade. And this is something which, which doesn't again have a news trigger really. Remember, there were reports from Bloomberg last week that Reliance has found alternate suppliers in Russia, not the two sanctioned firms, Lukoil and Rosneft, but other smaller suppliers to bring oil shipments and crude oil shipments back into the country. But despite that, we are seeing that there is a little bit of pressure as far as Reliance Industries goes. You've also got some positive traction coming in, at least in the consumer durable space. The auto sector is looking okay compared to the overall space that the Nifty 50 is operating in today. You've got Maruti Suzuki, Titan, as well as Bajaj Finance in the green this morning, but not as much positivity coming in from Mahindra and Mahindra as well as Eicher Motors, which are trading absolutely flat this morning. Let's look at the banking sector. Again, pretty much flat, barring Axis Bank, which is down about 0.5 percentage point or so. Overall, nothing really wrong as far as the banking sector also goes. But since we are pretty much coming to the end of the calendar year, I think it might be interesting to put in perspective how the Nifty 50 index has performed through the year. And this is where it becomes interesting, because if you see the IT sector, which has been pretty much the bellwether of the Indian stock markets for decades now, has had a terrible 2025 this year. This year alone, and remember, these prices that we are seeing on the charts right now are from the 1st of Jan to this moment today, the 29th of December. So as things stand, TCS has been one of the biggest losers this year, losing about 20% or so in market cap and its valuation. Meanwhile, other IT stocks like Infosys, HCL Tech and Wipro have also been largely losers, losing anything between 11% to about 13.5% or so. Meanwhile, Reliance Industries this calendar year to date has been among the biggest gainers, gaining almost 30% or so. And remember, Reliance Industries continues to be the largest Nifty 50 company, and in fact, India's largest company as far as market valuation goes. So you've got Reliance Industries up about 28% or so year to date. Meanwhile, great run for some auto companies. Look at Maruti Suzuki. The Maruti Suzuki stock this calendar year, 2025, has raked in almost 53% of gains for its investors. Meanwhile, a great year even for Eicher Motors, which is trading about 51.5%. That's almost 50% higher than its Jan 1st value. Mahindra and Mahindra also up about 20% or so. So this is a snapshot pretty much of what the year has been for the Nifty 50 companies. But remember, we will slip into a very short break right now. When we come back, a very special segment. We've got two market durandars, if I can call them that, who would be here to help us understand how to navigate the turbulence and the volatility and all the uncertainty in 2026. It's an interesting segment, and we've tried to add a little bit of a Gen Z flavor to it, and we've mixed some Bollywood memes also in the overall mix. So do come back after this short break. We'll have Nilesh Shah and Devina Mehra right here with us.
खेलता है झूलता उछलता है दौड़ता कभी कभी दौड़ कराता है आगे आगे बढ़ता है इंडिया अमूल दूध पीता है इंडिया.
A resurgent India is racing towards the Viksit Bharat goal, braving global economic headwinds. Bulletproofing our economy from these uncertainties are Bharat's homegrown businesses. Powered by tech-led innovation, Indian entrepreneurs are truly scaling up, riding the next wave of disruption with AI and cloud to break into the big global league. TV9 Network in association with SAP presents Visionaries of Viksit Bharat, a series celebrating inspirational business leaders shaping tomorrow. Watch them take an iconic leap at Visionaries of Viksit Bharat conclaves. Exclusively on News 9.
2026, take notes. Manifesting. For my little Miss Sunshine, tickles and giggles. Also wanna be a biker chick this time. And dear 2026, only love for my people and myself. To manifest my best life, nature's cosmic energy.
Now mine, natural diamond intention pendants.
You're watching News 9. This is our special coverage for what action should you expect from the stock markets in 2026. Remember, 2025 has been a year of FII exodus. It's also been a year where that all-elusive India-US trade deal did not really materialize. And it's been a year that we've seen commodity prices go through the roof, silver and gold surging like never seen before. So what should be your market playbook for 2026? We have two very special guests joining us today to help us and help you deconstruct your portfolio, help you understand everything that's happening in the world, and arrive at a strategy as you enter 2026 and stock markets in 2026. No surprises there. We've got Devina Mehra, founder, chairperson and managing director of First Global, joining us on the show. We've also got Nilesh Shah, the managing director of Kotak Mahindra AMC, on the show. Devina and Nilesh, thank you so much, and what a pleasure it is to have you here with us on this very special occasion as we enter 2026 and multiple doubts linger around what to do and what to expect as far as the stock markets go. So let's first begin with the both of you, and let me once again thank you both for your time this morning. Now, we thought, let's not do a regular market show. Let's actually try and add a little bit of entertainment to it. I don't know how big buffs of Bollywood you are. I know Mr. Nilesh Shah is a big cricket buff, but we thought let's bring in a little bit of Bollywood twist to our conversation this morning. So, Devna, first off, straight off the bat, all retail investors looking at their portfolios not growing at the same clip that they became accustomed to before 2025 have just one hope. And that hope is, mere FIIs aayenge. My question is, mere FIIs kab aayenge?
Question ही गलत है. So I mean, मैं तो यही बोलूँगी. So if we have to look at FIIs, if you look at just plot FIIs, net buys and net sells versus the market, and you will see there is no correlation between the two. So I mean, the sort of intent behind the question is that when the FIIs come back, then the market will go up, or if they exit, then the market goes down. That is simply not the case. So that, as I said, that's the wrong question. I mean, the direction of the market, if you want to know, the cause is not FIIs going in and out. So that's and this I'm talking the long-term history. And if you really want something from history, I will tell you, FIIs started investing in the markets around 1994. And before that, foreign investors could not invest in India. So you would have said that this massive liquidity is coming from a source which didn't even exist earlier. So the market will go through the roof. But What happened from 94 to 2003 is the only 9-year period in the market history when the net returns were zero. Sensex returns were zero for that period. I mean, it went up and it went down. So I mean, it is there's no correlation, let alone causation. So that's not the right question to ask, I would say that.
Not the right question to ask. Do you agree, Mr. Nilesh Shah? Because the exodus of FIIs seems to have been a worry for the last 6 months and counting, now at 1.6 lakh crore rupees of exits. DIIs have been doing the heavy lifting to pretty much keep the markets afloat. So do you agree with Devina that FII exodus is not really a big concern as far as liquidity in the Indian market goes?
So FIIs will exit only when there is liquidity. Otherwise, how will they exit?
Right.
And for the market, what matters is earnings, not who is buying and who is selling. As Devina mentioned, when they were buying for 10 years, market delivered no return.
Right.
Today, despite their selling, market is up moderately by about 6% last year and about almost 16% since March 20. So what matters for market is growth, governance, rather than who is buying and who is selling.
Right. So who is buying and who is selling? Well, it definitely seems that it is the retail investors who are buying, and they are buying hopefully in the hope and through DIIs in the hope that markets right now are at better valuation levels than they have been in the past. So there were conversations around the market valuation and overall some froth in the markets, till about a year back. Do you think with this correction that we've seen, at least in the indices, that sort of fear of froth and overhyped valuations has been arrested to some extent?
See, first of all, index level valuation, especially since most people look at PE, is not really worth looking at simply because the composition of the index has changed so much over the years. So if I go back, a little over 2 decades, there were no banks or financials in the main indices. Now they are the highest weight. At one time, these indices were full of public sector PSUs. And then there came a time when people forgot that they were PSUs. But if you plot the sectoral PEs, they're actually not at extremes, and they have not been at extremes. So as far as the mainstream stocks are concerned, last year also 2024, most of the kind of froth was more in the small cap, micro cap rather than in the large cap. So the large cap valuation for almost all industries were not at extreme ends. They're still not at extreme ends. And I do see an uptick in earnings coming up. So that is the other thing. The other thing which I would like to remind viewers is that sentiment is a contraindicator. Of late, I have seen most TV anchors or in other media, everyone is enumerating the risks. So that the focus is more on risks, and that shows, and people are asking that should I stop my SIP, should I get out of the market? So when those questions come, those anxieties come, and this is hard data, this is research studies done all over the world, not just India, US, but Portugal, Brazil, wherever the study is done, is that when people are asking these questions, the next period returns are above normal. When it appears that great returns are there for the taking, as was the case in the first 8 to 10 months of 2024, when everybody thought 30% compounding to kahin nahi gaya, so that is when the returns are below normal. So if you see the last samvat, you hardly got any returns.
That's right.
And even now, when the indexes that do show some increase for this year, if you look at the median stock in, let us say, the NSE 500 or BSE 500, they are still down. There's still a considerable portion of the stocks which are down more than 20%, more than 30%, which is why even though the indexes have done reasonably, you can say, the portfolios are still showing a lot of red. So I'm sure a lot of your viewers will not see the index returns on their portfolios.
Right. So index returns on portfolios not coming through, but the SIP strategy must continue if that is what you're saying, Devina. I hear you loud and clear that these are times perhaps to continue with accumulation even if valuations are low. But coming to the overall market...
Of your equity valuation, allocation, I must add that.
Increase
Never
your
have
allocation.
100% in equity, but whatever is your equity allocation, it makes sense to be invested.
Right. But Nilesh, we can't really take the sentiment away from either the commentary or the action that one sees on the stock markets. And I think one sort of lingering sentiment has been this, this ever elusive India-US trade deal, which is not just keeping FIIs on the back burner. They are also pretty much keeping exporters on the edge, and overall India's own macroeconomics to some extent depend on that trade deal with the US to come through. But we seem to have missed the December deadline. Are you hopeful that by March at least we will have the trade deal with the United States? Because in true Sunny Deol style, if we can bring up that meme now, in true Sunny Deol style, it seems like this is Tariq pe Tariq pe Tariq, but no real trade deal.
So in the Bollywood style, ट्रंप को समझना मुश्किल ही नहीं, नामुमकिन भी है. So let's leave it at that. US has levied absolutely unreasonable tariff on India.
Okay.
Even though we are not the largest buyer of Russian energy, and even though we respect US sanction on countries like Iran and Myanmar, which China sidesteps. Now, whether tariff deal will happen or not, it's difficult to estimate. But because of probably those US tariff deal impacting our exports, the government has unleashed reforms.
Yes.
The GST cut put money in the pockets of consumers. There is significant focus on infrastructure investment, ease of doing business. And even yesterday's the Chief Secretary's meeting with Prime Minister focus was on the economy. The second quarter GDP came at 8% plus, way ahead of everyone's expectation.
Yeah.
With or without US tariff deal, India will be fastest growing major economy. If US tariff deal happens, sone pe suhaga. But if it doesn't happen, then we have to leverage our domestic economy and continue to grow.
So you were talking about India's fundamentals and the growth numbers. So let's bring up on that account the next sort of Bollywood meme for stock markets that we have. Devna, do you expect up ki baar 8% par? At least H1 tells us that we are clocking a run rate of 8%. Do you think that momentum can continue given the fact that we are now looking at hopefully better Q3 earnings results also after the GST cuts, which should have led to better consumption? Can we expect hopefully clocking and continuing with this 8% run rate and say up ki baar 8% par for FY26?
See, I mean, even now, if you look at the GDP, a lot of the heavy lifting is being done by government expenditure. Yes, private consumption is now going up. The low for private consumption was in 23-24, so it's been going up since then. When people discovered it only when the market started going down that there was a problem with consumption, but actually the low was at 23-24. So consumption is going up, which is why I said, that's part of the reason why you will see corporate earnings going up. So, and part of why consumption is going up is that the inflation is low. So to some extent, I would say that the real GDP number is little bit overstated. And if you look at corporate earnings, they are really tied to nominal GDP, which not real GDP. Because and you actually calculate the nominal GDP and then use the inflation as a deflator. Right. So nominal GDP numbers have been actually quite low. And part of it, of course, as I said, is not just that the inflation has come down, but in certain products, the prices themselves have come down, which almost never happens, which looks like a very good thing, except that when you remember that nearly 50% of India's population is dependent on agriculture, 46% I think is the number. Yeah. And when food prices go down, their incomes go down. So it is good for the urban consumer, not so good for the rural consumer when the low inflation is driven by food prices. So that's the other side of the equation. But even so, I had expected earnings to have an uptick in the second quarter, but that got delayed as soon as the GST changes were announced because, that obviously disrupted the market in the short term, even though it's good for the long term. So then as soon as that was announced, my kind of expectation shifted that the real uptick you will see Q3 onwards. So that on the corporate earnings, yes, I mean, I still see good things. But part of that 8% number is an inflation anomaly. And I hope the other parts of the economy really go up and we are able to maintain that because we need to maintain that if we want the Viksit Bharat by 2047. We need to have 8% plus growth on a consistent basis.
8% growth on a consistent basis. So obviously it would be the GDP figure that one would want to keep an eye on, Mr. Nilesh Shah. But if one could sort of break down the first quarter of the calendar year 2026, we have hopefully three headline events. One is going to be the corporate earnings, which will start getting announced early mid-Jan onwards. Then you'll have the budget. And already we've seen the kind of exceptions that have been given on income tax, up to 12 lakh rupees of exemption, followed by the GST reforms that we've seen. Does the finance minister have any headroom now to give even more cash in the hands of citizens? Because that is the second headline event. And the third one, of course, is the trade deal. Whether or not, if and when it happens, that, of course, continues to be a question. But apart from these three, which is corporate earnings for Q3, the budget, as well as potentially the trade deal, are there other variables that one should keep in mind? Barring, of course, the inflation print, which Devina has already spoken about. Mr. Shah. Okay, I think we seem to have lost Mr. Nilesh Shah's connection right now. We will bring him back with us. But what we are trying to arrive at is that there are going to be some critical moments in 2026 which could define potentially the trajectory of the markets. One, of course, being the fact that that Q3 earnings are going to be announced, followed by the budget speech, and then, of course, the India-US trade deal. Hopefully by March, at least, that is the indication which is coming through. So if Devina Mehra, in case these were to come through, these three were to come through, can we expect a bull run in the Indian markets? And then again, going back to our Bollywood meme flavor of the day, can we sort of expect that, that the bulls right now, which are caged, are pretty much the Ranveer Singh of Dhurandhar, who are saying that घायल हूं इसीलिए घातक हूं. Once these three tick marks come through for the Indian retail investors, then there is no stopping the bulls?
Actually, I mean, you don't even really, I mean, for bull markets, we look for triggers in hindsight, and exactly the same things can be used to explain either a market rise or a market fall. And risk is always something you didn't see coming. But as I said, earnings, I do expect an uptake, which means that the Ps will start to look even more reasonable. On the budget, I don't know how much room there is for good news, because even last budget, I don't know how many people picked up on this, but if you looked at the personal tax estimates last budget, personal income tax was cut, but you'd be surprised that the collections on personal income tax were budgeted to grow by 14%. Whereas GST and corporate tax were supposed to grow by 10.5% in line with the nominal GDP estimate. Right now, we are not even at that nominal GDP. That's another matter. But I'm saying, why was the personal income tax supposed to grow when you were by more than all other taxes when you were cutting in personal income tax rate? And as I said at that time itself, that there might be regulators trying to curb excess speculation in capital markets, but the government budget is really banking on it, because obviously the higher taxes were supposed to come from the capital market related taxes. And maybe, I mean, I have not looked at the recent data, but sometime back I had seen that that all that day trading, etc., the volumes are falling. So maybe, yes. I mean, this year also, I'm not sure whether the personal income tax targets would be met as per the budget in beginning of the year. So that's that's one question mark. So I don't know whether there's any room for any good news from the budget. And the budget, I would like to really concentrate on on employment, education, health. That's the not capital market is never my ask for from the budget.
Absolutely. But of course, I mean, for job creation, potentially some additional schemes beyond the PLI for the manufacturing sector and for, as they call, the animal spirits of corporate sector to be unleashed. But let's say we are, Mr. Nilisha, in case we are to sort of, check the boxes on these three accounts, solid Q3 growth, hopefully with the GST boost, potentially some good news coming by way of the union budget, and then, of course, the India-US trade deal, hopefully by March. Can we safely expect Nifty 50 to touch the 30,000 level in 2026?
So it's always difficult to predict market in the short term. But continuing your Bollywood theme, I will say market will be still kahani kismat ki. Last year, we did see divergence between large, mid and small cap performance and valuation. And in 2026, while those range will narrow down, it will still be a year of stock selection and sector selection. There will not be a very broad-based rally. There will be moderate return, and you'll have to pick your stocks and sector carefully. So I will say 2026 is not Dhurandhar year, it's Kahani Kismat Ki.
Kahani Kismat Ki. It's not going to be a Dhurandhar year, it's going to be Kahani Kismat Ki. We will come to your specific, sectoral and potentially any other news-based or event-based sectors that you would want to highlight. But before that, Devina, commodities have been on a wild run. Silver and gold prices have gone through the roof. So investors who have missed out on this gold and silver rally would be pretty much like Deepika Padukone style saying, "Ek chutki gold ki कीमत tum kya jano." Is this gold going to become all the more expensive in 2026? We know that silver demand, likely with the curbs that China is likely to introduce from the 1st of Jan, could sort of continue with the silver story, touching some experts saying as high as 2,75,000 rupees or so a kg. But is this gold story also going to continue into 2026?
I would like to tell your viewers that the worst reason to invest in anything is a FOMO feeling. So, because that always derails you. And this is statistical again. If you chase the sector or the asset class that has done well of late, systematically you will underperform. In our multi-asset products, whether it is global or India, we always have allocation to precious metals, but it's more like a single-digit allocation. So it should not be that 30% or 40% of your money is in things like this. Silver, of course, has an industrial story also. Gold, let me also remind your viewers that in dollar terms has been a more volatile asset than equities.
Right.
And I had some time back seen that there was a headline saying gold has not seen a rally like this since 1979. And if you go forward from 1979, gold made a high in 1980. That from 19 years later in 1999, it was down still 62% over nearly 2 decades. It came down 62%. And the high of 1980 was not crossed till 2007, 27 years. And it was not an anomaly. The next high, again, it fell 40%.
Okay.
The rupee chart of gold looks decent only because it is a rupee depreciation chart.
Oh, I see.
So,
Right.
हमारी नानी दादी गलत नहीं थी सोना खरीदने में, because at that time, gold was the only hard currency asset you could buy. You could not buy anything else internationally. You could not invest in international markets. But now that is not the case. Now you should get your proper global exposure and outside the US also, not just the US.
Right.
And use precious metals, but should not be a huge part of your asset allocation. That's it. That's what I would say. And also, I mean, a thumb rule I repeat often, that the easiest way to see where the froth is in the market is to see where all the new fund offerings are clustering, because they always come when that theme has gone beyond maturity and is close to the peak. This is again data over 25, 30 years. You see anything, whether it is IT fund, pharma fund, defense fund, small cap fund, they all cluster when the theme is peaking.
Right. Okay, so that is the story as far as historic data goes and the potential valuations go. But let's come back to Nilisha, the kahani Kismat ki that you were talking about. Which are the sure shot Kismat ki kahaniyan brewing in 2026? Let's come down now to the brass tacks, to the sectoral focus. If you were to sort of give all our viewers and the retail investors out there some buying calls for 2026, which are the sectors that you would ask them to focus on?
So our focus from a capitalization will be select mid and large cap over small cap. We think earnings growth in mid cap is fairly good. And while valuations are little on the fair value plus side, select mid caps and large caps will deliver better return than overall small cap. From a sectoral point of view, we believe consumer discretionary space is attractive. Government is putting money in the pockets of consumers. There was tax cut of about 1 lakh crore in this year's budget. The GST at the bottom of pyramid on an annualized basis is about 1,92,000 crore. Of course, it does take away some money from top of pyramid. There is interest rate reduction, which is ensured about 1,80,000 crore savings on EMI burden of borrowers. Gaming has been banned. That could leave about 1 lakh crore in the pockets of speculators. And somewhere towards 2027, we will see 8th pay commission coming into play. First for about 1.2 crore government employees and pensioners and defense persons and PSU employees. And then eventually for state government employees. Put together, there is money in the pockets of taxpayers, consumers, EMI borrowers, speculators, and government employees. Wherever this money will be spent, those sectors will witness growth and hopefully margin expansion. So consumer discretionary space ranging from airline to travel to tourism to health to probably home improvement is the sector to look forward over next 2 to 3 years.
All right. So any place where consumers could go and spend money, I think that should be the barometer. That's the word coming in from Nilisha, that is where the likely growth will come. I was looking at the auto stocks, Mr. Shah, and those auto stocks, of course, which are also in the discretionary category, have returned tremendous investor dividends this year. In fact, Maruti Suzuki year to date is up about 50%. Mahindra & Mahindra is up about 20% or so. Devina, let me come to you with the same question. If investors looking for advice from you were to sort of take your word and bet on certain sectors for 2026, what would be your advice to them?
See, normally, I mean, we relook at our allocation every quarter from base zero. So I'm not sure what I'm telling you today will hold all through 2026.
Okay.
But I can tell you where we are overweight sectorally, and that is auto components. It is pharma and healthcare. And it is this year, 2025, where we have added through the year has been FMCG. So we talked about the consumption story a while back. There was a time last year when the inflation was so high. It was literally, I mean, when the dal and oil prices are high, it literally crowds out even toothpaste and shampoo from household budget. So that there has been a relief. So FMCG is definitely something. Banking, we're not overweight, but this year, through the year, we have added banking first in the PSU pack and later on and some others. I'm normally very underweight banking, but this has been the turnaround year for banking. IT might be the kind of dark horse. It has been a pretty bad performer for 2025 and in fact for some time before that also. So just as banking for the 5 years prior to 2025 was a huge underperformer every year, barring one exceptional year, which was 2022. So something like that has happened to IT, and that might be the thing that changes in 2026. So broadly, otherwise it is on the stock picking. So, I mean, we have things which are good in capital goods, things which are good in chemicals. We've added some oil marketing companies, though we're not overweight there, but that's broadly the pattern.
All right. Well, on that note, let me thank you both. Devina Mehra, Nilesh Shah, what a pleasure having you here with us on this market playbook for 2026. Well, if I can just quickly recap the advice which is coming from you, consumer discretionary stocks should be in focus, and look at the mid-cap and the large-cap stocks. That is a word coming in from Nilesh Shah. Devina Mehra arguing that it could potentially also be an opportunity to dip into the FMCG space, and potentially the dark horse in 2026 could be the mostly undercut IT space, which could emerge as the dark horse. Well, on that note, Devina and Nilesh Shah, thank you so much for your time. It's been a pleasure having you here with us on News 9 through the year. And I wish you both, and from all of us here at News 9, a very happy and prosperous 2026. Thank you so much for your time.
Thank you.
And with that, we come to an end of this special edition of the Market Playbook for 2026. Thank you so much for watching. We'll keep getting you more insights all through the year right here on News 9.
This is India's #1 news network, and you're watching News 9. English news as it should be.
2026, take notes. Manifesting. For my little Miss Sunshine.